I'm Michael Waldron, Director of Portfolio Management at Heritage Financial Services. Thank you for watching my presentation of the real deal economy. Inflation and the monetary policy used to address it has been the main market focus since 2022. Let's rewind and take a trip through the past 3 years. Throughout 2021, the Fed funds rate was flatlined at its COVID low of 0 to 25 basis points. In the summer of 2021, inflation moved up from sub 2%, which is below the Fed's long-term target, to 5%. Fed Chairman Powell, surely regretfully, termed this transitory inflation that mostly had to do with supply chain issues that backed up during the first and most chaotic year of the pandemic. In 2022, a new adjective, persistent, attached itself to inflation. The Fed very aggressively increased the Fed funds rate, inflation hit a high above 9% in the summer, and by October, the stock market had fallen by more than 25%, coinciding with a double-digit loss in investment-grade fixed income. For the first half of 2023, inflation steadily declined from over 6% to under 3%. Equities performed well as markets saw inflation come under control without an accompanying recession. Meanwhile, fixed income was flat as higher for longer crept into the yield curve, and intermediate to long-term rates increased more than the slower-paced Fed fund rate increases. Then in the third quarter, the Fed paused. The economy didn't reject the policy outright, but it hiccuped. Inflation rose from under 3% to 3.7%. Worrying investors that more restrictive monetary policy would be necessary, coming with higher recession risk. Fixed income went negative for the year, and equities gave up 2/3 of its accumulated gains. The fourth quarter saw inflation come back down to 3% without additional monetary tightening, and the Fed signaled a more accommodative policy in 2024. Equities and fixed income soared into year-end, settling at their highest levels, with global equities up 22.5% and investment-grade bonds up 5.53% for the full year. So how have we handled this within portfolios? In 2021 through 2022, we had very low fixed income duration because rates were so low. That saved portfolios much of the downside the bond market experienced in 2022. Since then, we've termed out our fixed income to an intermediate maturity profile. Going into 2023, we were very excited about traditional market pricing and entered the year with each of our objectives targeting a higher level of risk than our baseline profile. This resulted in full equity allocations that experienced a terrific return to start the first half of the year. As we entered the summer, we took off our aggressive stance and returned to baseline, overall rebalancing from equities into fixed income. In the third quarter, when it wasn't clear the economy could hold down the pause in interest rates and maintain reasonable inflation, having reduced equity risk resulted in portfolios holding up better. In the fourth quarter, both equities and fixed income boomed into year-end. We reduced our real assets allocation in mid-November and added the proceeds primarily to fixed income. Fixed income as an asset class had an excellent final 2 months of the year. As we enter 2024, we're now modestly more cautious about taking risk. The spread in return that we expect equities to return over fixed income is tighter than it was before. One must remember the fears coming out of 2022. That was a very hard year for investors. There was a high consensus that 2023 would include a recession. Despite that, we entered the year aggressively and experienced an excellent return from equities. After we consolidated much of our wins, the stock market gave up much of its accumulated return from 18.11% down to 5.53%, a 12.58% reduction in accumulated return. With fixed income slightly negative for the year, in the early portion of the fourth quarter, we sold real assets at a gain and started buying high-quality fixed income where we thought the prospective returns looked very healthy. As we bought, the bond market rallied, cumulatively in the fourth quarter by 9%. Going into 2024, we are at a new strategic asset allocation that is more conservative. our expected return for fixed income increased as high-quality, intermediate-term rates remain attractive. Meanwhile, our expected returns for equities declined. After a strong year for equities, where price appreciation exceeded the current earnings yield plus growth in profits, the consequence is a lower expected return going forward. We believe our fixed income allocation is important for 2024. Over the course of the last year, the participants in the Federal Open Markets Committee shifted down their expectation for where the Fed funds rate would be at the end of 2024. The market agreed, and its expectation in the fourth quarter for the Fed funds rate at the end of 2024 and 2025 dropped significantly in 2025 by 2/3 of a percentage point. Think about how a 5-year Treasury performs over a year, subject to potential interest rate scenarios. If the 4-year rate rises by 1%, causing a capital loss, and an investor collects her interest on the bond, the total return would be approximately 30 basis points. Rates rising is certainly not the base case. If the 4-year rate falls by 1%, between interest and capital appreciation, an investor would approach a total return of 9%. So why not go more heavily into fixed income? Remember, your overall financial goal is very important. Our return expectation for equities over the next 10 years is still higher than for fixed income. It's just the spread between the two has compressed. If we look at global equities over the past 2 years, the total return is almost exactly zero. The blue portion shows 2023. Viewing it with the year behind gives some context. Now, over the past 2 years, profits have been earned by companies and added to their balance sheet, and the underlying company's revenues have increased and profits have increased. By no means are we negative about the potential for global equity returns. We think the pricing is reasonably attractive. Where we are more skeptical is about the Magnificent Seven stocks: Apple, Microsoft, Alphabet/Google, Amazon, Nvidia, Meta/Facebook, and Tesla, all in the top 10 largest companies by market capitalization. Companies take leadership with strong historical operating results and typically strong stock performance. Before joining the top 10 largest companies, stock performance typically is very good. But look at the 3, 5, and 10-year average returns after joining the top 10. Eventually, a company can't continue to win new market demand and market share. How did we navigate 2023? We entered the year aggressively, excited about prospective equity returns. After a lucrative first half, we rebalanced from equities into fixed income and reduced the volatility that was experienced in a major stock market reversal. In November, we sold real assets and added to fixed income before the asset class produced the majority of its return for the year. And at the outset of 2024, we're entering cautiously with healthy fixed income allocations. So what's the real deal? Despite recession predictions after 2022, being aggressive in financial markets in 2023 was the right call. As we enter 2024, we have tightened our return expectations from fixed income to equities. With this compressed return expectation between high risk and low risk asset classes, it's a good time to approach investing more cautiously. And while the Magnificent Seven stocks carried equity returns in 2023, we believe it's important to diversify in other companies in the US and internationally in 2024. Thank you for your time, and I hope you tune in next quarter as we dig into the economic data and sort out what to ignore to get to the real deal.